Good evening, everyone. Welcome to Investor Education Program by NCDX, and topic for our today's webinar is GUR Futures. So all attendees will be in listen and only mode, and during the presentation अगर आपके कोई भी सवाल हो तो आप अपने Q&A बॉक्स में टाइप कर सकते हैं, and at the end of our presentation we will take your questions. So just to tell everyone, NCDX will be relaunching its GUR Wheat Gate Futures contract on 15th of December. तो हमने ये वेबिनार उसी कॉन्ट्रैक्ट के बारे में डिस्कस करने को लिया है. So before discussing about GUR, let's have an overview of commodity derivatives ecosystem in India. Commodity derivatives trading date back to 19th century with the establishment of Bombay Cotton Trade Association. And after the establishment of Bombay Cotton Trade Association, other trading in other commodities was also started, like in oilseeds, in jute, in wheat. So we earlier had Hapur Chamber of Commerce for wheat. We had Calcutta Exchange for jute. Then after that, in 1953, Forwards Market Commission was established in 1953. And after that, in 20th century, for some time, futures trading was banned. Then in 2001, Government of India extended the list of commodities for derivative in trading, and Government of India allowed futures trading in commodities. And with that, in 2003, national level commodity exchanges was started their operation. And in 2003 only, NCDX also started its operation. And then in 2015, SEBI, which is Securities and Exchange Board of India, became the regulator for commodity exchanges in India also. So coming under the SEBI, and all national exchanges are regulated by a single regulator, which is Security and Exchange Board of India, which comes under Department of Economic Affairs in Ministry of Finance. And as of now, today, 91 commodities are permitted for trading in derivatives market. In these national level exchanges, NCDX, MCX, and ICX are majorly commodity exchanges, and NSE and BSE are stock exchanges, and in recent year they have started offering commodity tradings also. Now, with the strong regulatory support, commodity markets in India has undergone some very positive changes in the recent year. In 2015, after SEBI became the regulator for commodity exchanges, in June 2017, SEBI permitted options in commodity derivatives trading. And then SEBI in 2017 in September, SEBI permitted the integration of equity and commodity arms of broking, and bank subsidiaries were also allowed to distribute commodity trading, and banks were permitted to participate as a professional trading member, which is foreign portfolio investors who had their exposure in Indian markets. They were also allowed to trade on this platform. Then in March 2019, mutual funds and PMS have been allowed to participate in commodity derivative segment. Then in 2019, commodity indices have been allowed to trade on the exchange, and in 2020, NCDX launched its commodity index Agridex, which is a cumulative of 10 commodities which are traded on the exchange platform. Now here is the list of commodities which are available for trading on exchange platform. These in cereals pulses are bajra, barley, chana, coriander, jeera, turmeric. In fibers, we have cottonseed oil cake, kapas, and cotton. In guar complex, we have guar seed and guarcum. And in oil and oilseed complex, we have soya bean, refined soya oil, mustard seed, castor seed, crude palm oil, and sesame seed, which was launched very recently. Here is just a key difference, which is in commodity derivatives and financial derivatives market. So in commodity derivatives, these are settled by actual delivery of the goods, and while the financial derivatives, they are cash settled. and the quality and quantity difference exists in commodity market, whereas in financial market all shares there is no such difference in terms of quality and quantity. Then in commodity markets, a holding cost such as SCing, warehousing cost, and insurance cost is involved, whereas in financial derivatives market, only the interest cost is involved. And in commodity derivatives market, physical markets are seasonal in nature, whereas cash markets are active throughout the year. And commodity derivatives market are impacted by the demand and supply of the commodity, by the export import regulation, by the intervention of government in that commodity value chain and trade. Whereas in financial derivatives market, they are influenced by the economic condition and the performance of the entity or on the taxation structure that is being followed in a country. Now we will have a look at the GUR futures contract, which exchange will be launching on 15th of December. So we'll have a look at how this contract is designed to align with the market. So GUR, or it is also known as jaggery, in is a product of sugarcane, and India is the largest producer of GUR in the world, and we produce nearly 60% of the global GUR production. And globally, Brazil is the major exporter of jaggery, and USA, China, and Indonesia are major importers of jaggery in the world. Global production of GUR is 13.6 million metric ton, and this is for the year 2018. And in India, Uttar Pradesh, Maharashtra, Karnataka, and Tamil Nadu are major jaggery producing states, and these states combinedly produce 80% of the total jaggery production in India. So, as I already told, GUR is a product is derived from sugarcane, and so we will look at the sugarcane. It is harvested during January, February, March, and April. And in mandis, arrival of GUR in major producing state is given below. Like in Uttar Pradesh, has been number one in terms of arrival of GUR in the mandis. Next is Maharashtra, then Karnataka, and Madhya Pradesh in recent year. Now, this is the typical value chain of a GUR. So, because it is derived from the sugarcane, so sugarcane farmer brings sugarcane to the jaggery processor, where GUR is processed and it is then aggregated by a wholesaler, trader, or commission agent, which is then transferred to domestic retailers, or from there it reached to customers. So the price of GUR is highly volatile, and the volatility is more than 15%. So this high volatility in the prices is the major reason which require a risk mitigation futures contract to mitigate the price risk arising out of volatility. And a considerable amount of total production of good. It is also used in feed. So we NCDX is launching its good feed grade futures contract to mitigate the price risk arising out of it, because the price has considerable amount on overall feed costs. And on the basis of huge production, it can be said that commodity is available in large number, and therefore there is no hindrance for the introduction of this commodity in the futures market. Now here is a chart which shows volatility in the last 3 years, and inside of it there is a spot price and future price movement which is shown in GUR. So in 2018-19, 19.2% of annual volatility was observed in GUR, and which is very high. So now we'll look at how this future contract is designed. So for our GUR feed grade futures contract, Muzaffarnagar in UP will be our basis center, because Uttar Pradesh is the largest GUR producing state in the country, and it produces 47% of India's GUR production. And also Muzaffarnagar is a big center, and Muzaffarnagar and nearby areas, they have a key trading and production facility, and large set of value chain participant players are based out of here. Also, Muzaffarnagar has good availability of infrastructure, and Muzaffarnagar prices are considered as a benchmark for the discovery of good prices. Now, here is the contract specification for good feed grade futures contract. So, the ticker symbol that you'll see on the screen will be GUR, and the unit of trading is 10 metric ton. The quotation will be in rupees per 40 kg. Tick size is 0.50, and the basis center is Muzaffarnagar, storage warehouse of Muzaffarnagar, and delivery is compulsory delivery like most of our contracts. And the expiry date is 20th of every month, and if 20th is a holiday, then expiry date will be 19th. Here is the quality specification for good future feed grade contract. So the sucrose should be minimum 75 to 80%, and reducing sugar should be maximum 10 to 15%, not more than that. Moisture should be 10% maximum. Sulfur dioxide is 150 ppm maximum, and water insoluble matter is 1.5% maximum. Sulfated ash is 3.5% maximum. Ash insoluble in dilute HCl is 0.3% maximum, and 100% dry golden brown cane gur of Chaku type, which is having the above mentioned parameters, will be deliverable at Muzaffarnagar cold storage warehouse. So we will be launching our good feed grade futures contract on 15 December, and January, February, March, April and June expiry contracts will be available for trading. And thereafter from January we will have contracts expiring for July and so on. So this was about our good futures contract which will be launching on 15th of December. Now here are some investor guidelines which every investor should always look at. So these are some tools. A client should always get themselves registered through a SEBI registered broker only and should trade through a registered broker only. And a client should fill their KYC mandates and should get their unique client code, and insist clients should always insist on bill or contract note for every settlement that happen in their account, and ensure that the contract note which is given to you by your broker, it contain all relevant information such as member registration number, your order detail, your trade number, your quantity and arbitration call, and etc. And you should always pay your required margin and M2M obligation in time, and understand the consequence of non-payment, and beware of the risk associated with dabba trading, and always issue account pay check or demand draft in name of the broker as it appears on the contract or the SEBI registration certificate, and always insist on periodical statement of your account of funds and securities from broker. And funding from unauthorized intermediary are not covered under settlement guarantee mechanism of the exchange. Hence, one should always be careful of these things. And as already said, don't deal with unregistered intermediaries. Deal only with the SEBI registered broker. Don't take off market transaction, and don't believe on the alluring advertisement which offer you assured returns, and don't start trading before understanding the risk disclosure clause. Don't accept unsigned duplicate contract notes. Don't fall prey to market rumors. Don't let risk against position accumulate beyond your capacity to bear, and don't simply go any explicit promise made by the analyst and expert. One should always do their own research and then take informed decision. So with this is the end of our presentation on good futures contract. So any question you have, you can type in Q&A section and we'll take your queries. So we don't have any question as of now. So we'll close this session here. And in case you have question later on, you can contact us at askus.at@ncdx.com and we'll answer your query. Thank you for attending our webinar, and